Thank you all for joining. I'm really excited for tonight. This is definitely my favorite topic out of all of the different weeks. And so I'm really excited to be able to share with you all. I am working from 2 screens this time, so we'll see how that goes. And let me just start off by sharing my screen and presenting. We have an amazing guest speaker tonight, and her name is Jennifer. She's on with us right now. Perfect. All right. So we're really looking forward to hearing more about Jennifer's story. As always, we'll start off with a little bit of an intro into multifamily before we dive in. And let's do it. So you guys can see my screen. It says Real Estate Investing 101. Okay, great. So thank you all for joining again. My name's Caroline Ehler, and my real estate investing company is called Gen Z Equity. I really want to share more about real estate investing, specifically with our generation, and teach people these skills because this is how we'll be able to build generational wealth. It's worth thinking about right now, even when we're young or early in our careers, because it can certainly change the way that you dictate your finances, and as you maneuver your career, what you might end up doing. And I love real estate and I love talking about it. So let's dive in. So we already went through our first 2 weeks. We had our introduction. And then last week we had our BRRRR method and long-term rentals topical discussion. This week's will be about commercial and multifamily real estate investing. So those are definitely different. And I chose to compare long-term rentals and multifamily because instead of something like short-term rentals, because I think that they're so incredibly different, and I really want to share how vastly different real estate investing can be. And I think something like short-term rentals and long-term rentals are pretty comprehensible to anyone that is familiar with maybe buying homes, but multifamily and commercial are just such different animals that I think it's really interesting to compare those two rather than comparing long and short-term rentals that are usually compared. So just wanted to introduce myself. If you don't know who I am, my name's Caroline Ehler, and I am in the Northern Virginia area outside of DC. That is my Instagram. You can go and follow me on Instagram. I share a bunch of real estate tips that range from real estate, realtor stuff, all the way to investing. And I personally invest in multifamily real estate. We'll talk more about what that means, why I have 390 GP units on there, and what that actually means and translates to. And I'm a member of the Roger Cleef Warrior Program and Boardroom, just like Jennifer is. So super excited to be able to share the spotlight with another warrior. Super special. And that is a QR code with my contact information. So if you want to be able to contact me, set up a meeting, or set up a one-on-one time with me, you can go ahead and use that QR code. This video will be posted on YouTube. If you haven't already gone to my YouTube, you can go and see our first real estate investing webinar series. We're getting last week's up, and then you please go ahead and like and subscribe. It would mean a lot. And you can do that through this QR code too. Okay, awesome. So today we are talking about multifamily. I really want to be able to go over a lot of the jargon, a lot of the terms that I think are used a lot in multifamily and commercial, but are never really explained. And so if you ever see things on social media or you watch YouTube and you're following real estate investing, you might have heard some of these terms, but I think it's when you're new, it can go over your head. And so I really want to do a deeper dive into a lot of those different words that I was confused about when I first started learning. And as always, I would love for everyone to ask your questions, and you can do so through the chat, or you can raise your hand on Zoom, or just come off mute, no worries. If you have questions that you can think of right now, put them in the chat. We'll be sure to answer them. And then we will go through, we'll also open the floor up to Jennifer, and she'll be able to share more about her experience with multifamily. She's a seasoned real estate investor, so she'll absolutely have a lot of wisdom to share. And then lastly, we have our Q&A. So if anyone has any questions, you want to save it to the end, go for it. We'll have time to be able to talk. And as always, we'll end promptly at 9. All right, let's do it. Multifamily and commercial. So firstly, commercial real estate is again a different animal than what we would call residential real estate. Residential real estate is when you're buying a house, you're buying a duplex, a fourplex, whatever. It's 4 units and under is residential. 5 and above would be commercial. Commercial is very different because you usually go about acquiring financing for those different assets differently. You might use different deal structures. It's not as simple as down payment on a home, you get a mortgage, and you worked with a bank to be able to acquire that property. So that's why they're considered different asset classes, and they absolutely require different investing strategies when you're looking to buy a commercial property. So commercial can include retail stores, offices, hotels, warehouses, storage, industrial, things that are typically rented out. If you can't tell that's the strategy behind it, is someone owns a building and then they rent out the office space or the store or whatever it might be, the shopping center. Multifamily would be a subsection of commercial, but multifamily is interesting because those other different asset classes under commercial, they're rented out, but people don't live there. Multifamily is different since people actually live there. And it seems to be similar to, it's like a blend between commercial and then a residential asset. And again, that's 5 units or above. So that is the definition of the two and how they are similar but different. And again, multifamily falls under commercial property. All right. Let's see. I have a bunch of terms on the next slide. We can just, I think, dive right into it. So specifically talking about multifamily, multifamily is an apartment building, right? Is essentially what it is. Maybe it's only 5 units, but if you want to think about it in terms of like giant skyscrapers, you can also think of it that way too. There are different classes of these types of buildings, A, B, C, and D. And these are different grades that the building will get to be able for an investor to determine what type of property it looks like. We have a standard usually, so we can talk to other investors very quickly and be able to assess what type of property it might be. And a class A property is usually pristine, or it's pretty nice. It's relatively new. It has nice finishes and amenities. So it's something like a gym or a pool. So if you're thinking about what that might look like to you, maybe in college, you knew what that one nice building was that people might have lived in. A class B property, again, thinking of like where you might have gone to college, what would that property have been? It's usually something that's older. It doesn't have maybe all the nice finishes, but it's still livable. It's totally livable. Doesn't have a gym usually. And then C and D get progressively older or less high quality. And so C would be 30-ish years old. And D is usually also determined based on where it is. So an A and B property is determined basically by the finishes, but it might be both. They might both reside in a nice area or in a populated area that's a very desirable area to live in. But then C and D, you might get further out from a city or further out from where that livable area is. And so those different terms are how we can determine and speak and communicate to other investors what type of deal we're in. And it also determines how you might actually end up structuring the deal, or it might affect your financing if you know that you have to do a lot of renovations to a property because you want to take it from a C to an A or a C to a B. Okay. And that's something we've already talked about before. We talked about value add properties, and value add properties are usually things that we're looking for to renovate, to add value, because then you can acquire more equity and then eventually refinance and pull that back out when you gain equity because a property appraises higher, it's evaluated to be a better property. You get to pull out money faster. Underwriting is a really big term in multifamily and commercial. This is something that definitely differentiates someone from the residential space. You can get away with not understanding underwriting sometimes in the residential space. You cannot do that in commercial. And underwriting is what a loan person will do. If you're looking to buy a house, when you're looking to get a mortgage, the bank is going to underwrite your loan, meaning evaluate the status of the property, your financial situation, and see if you qualify to be able to be lent that money. Because if it's a risky situation, they're not going to just hand other people mortgages or money. So that same rule and system is applied to multifamily and commercial, but a lot of times us investors will do it ourselves to determine if this is a good property for us to buy. Is it a risky property, or is it going to be a profitable, cash flowing property? And so we do that through a process called underwriting, which is basically a giant, this is not a good example of it, this is a pro forma, but basically you can utilize a bunch of math, a bunch of economics terms to determine if the property is going to actually ensure that you're going to make money if you do everything right. If you aren't going to make money on it, and you can see that from day one because the rents are too low and the expenses are too high on this property, you don't want to buy that. So that's what's really nice, is you can learn this really interesting skill of underwriting, especially if you're a mathy technical person, to be able to determine if it's a good deal or not. So you don't actually have to jump into deals that you're not comfortable with. Okay, pro forma, I just showed you it. This is what we utilize to determine if it is going to be a good property. This is how you would basically underwrite the deal. So you can go in and see, in a what if scenario, what it says fiscal year 1, what the first 2, 3, 5, 7 years are going to look like if you have this property that you buy and you hold it for a couple years. At what point will you become profitable? Will you get your money back, or will you return that money to you all, to any investors in the deal? So that is this big Excel sheet is basically called a pro forma, and is again a system that we use to basically determine if did it go away? If it's a good deal or not. So when you're looking at pro formas, when you're looking at underwriting, you're looking for cash flow, NOI, and CapEx. Those are key terms here. If you're not familiar with economics, this is something that I've had to learn myself. NOI is net operating income. CapEx is capital expenditures, and cash flow is cash flow. We've already talked about it and a lot of other things. I'm not going to spend time on these. Watch a bunch of YouTube videos. Trailing 12, T12 is what you would use when you're looking to buy a property to a lot of times fill out that pro forma. So the listing agent knows to give you information so you can actually determine if it's a good deal or not. You don't look at the property on Zillow and then just buy it. They will give you more information that you can look at to be able to determine if it's a good property. You get to look at financials. So you can ask for a trailing 12, which is the last 12 months of financial records for a property. All right. The next biggest things, let me look at my time, are the way that these deals are structured. And this can apply to commercial property as well. It's not multifamily specific, which would be syndication or joint ventures. These are really big buzzwords, I would say, but they're really important to understand. And they offer a different type of way to buy property. So instead of being one person buying a property, like maybe you bought a rental house or a beach house and that was your, residential real estate investment. With multifamily and commercial, you can utilize essentially like crowdfunding to be able to buy all of these properties because their price tags are usually hefty. So you can utilize two different avenues. One would be a joint venture or syndication, and both allow you to bring in other investors in on the deal, but they're a little bit different. So joint ventures you would do with just basically your business partners, and it definitely looks different from syndication, and the SEC classifies these very differently, and so you really have to understand your deal structure and which one they'll fall into. But syndication is basically the crowdfunding version of buying real estate, and it allows you to have your business partners, and then you can also bring in other people that are investors that will basically hand you money, expect a return on that investment since you will have acquired equity and appreciation on that asset, or increase the income, etc. So what's interesting with, oh wait, I'm not done. So LP and GP, that's the unit count I had originally before. So I had three something GP units. Those are very distinctive because an LP is a limited partner and a GP is a general partner. And those are really different. So a limited partner in a syndication deal would be someone that handed money in the deal and they do nothing else. So they'll be able to completely passively invest in that deal. And that's really desirable to a lot of people. So they can hand over money that they're looking to grow and hope outperforms maybe the stock market because it's in that asset. And then the GP team is the one that actually carries out the business plan. So they're the one calling the broker. They bought the property. They filed the taxes. They looked at the rents. They hired a property manager. They handled the property manager interactions. They filled all the rent, made sure there were no vacancies in the building. So the GPs essentially do the work on the deal. They can also put money in, but those are very different. And sometimes people will say, I have 80 LP units, but I have 400 GP units. So they probably do more work on deals than they do passively invest. So those are just key terms to listen for when you hear other people are in commercial real estate. You can certainly ask them this type of question: how many units do you have? And are you a GP or an LP? Buying multifamily or commercial properties are way more similar to buying businesses than they are buying what you might be thinking of real estate, where you buy the land and it appreciates in value. But multifamily and commercial are very different since they're not evaluated based on the comps in the area. There might not be comps in the area. What's interesting is every property that falls under this asset class is evaluated based on the income that it produces. So if you're an investor and you're looking to buy a property and you know it's evaluated based on income, what your goal is to increase that income. And you think about it, how would you do that on something like an apartment building? You would raise rents. You could add in different income streams. Maybe you charge for parking. Maybe they weren't charging for parking before. You can add in maybe there's space for retail space, or charge for maybe the laundry or something like that. There are lots of different ways to add income and to increase the income of a property in a way that makes this look much more like purchasing a business, operating a business, and improving a business, rather than just buying a vacation home, filling it with renters, and then hoping it appreciates over the years. So it's very different in terms of investment style and strategy. And finally, when you buy a property, you certainly hope that it appraises higher later on. Maybe you bought a property that you could renovate. You bought a value add property where you could go ahead and improve the different units, and you got better countertops or something like that, and could charge higher rent. But the goal is to eventually, while that rent is being paid down, while the mortgage is being paid down, basically, through all of the renters in the building, and you increase the value of the property because maybe you added those granite countertops, you will see that the property is now evaluated at a higher price because you raised the income. And then if you have the chance to refinance and pull cash back out, usually that gets returned to investors so they can be satiated and they see that they received a return on their investment. You can keep that asset beyond that. So then another maybe 4 years go by, you had the mortgage paid down even more, those rents paid it down, and then you can do it again in a couple years, and you can do it again in a couple years. So, and then eventually one day maybe you sell it. And that's another opportunity to get more cash in your hand. So when a deal goes from acquisition to, Jennifer, correct me if I'm wrong, I think a first refinance, is that considered full cycle? Okay, great. So once you hit that first refinance, that would mean that the deal went full cycle. And that's another good question you can ask people is, have you had a deal go full cycle yet? And that can tell you if they've been in the real estate, in the commercial industry long enough to see a deal go full cycle, meaning they were able to successfully take cash back out of a property that they were able to increase in value. And that usually means that they've been in the industry at least 3 years. That's the average. I'd say 3 to 5-ish years for a deal to go full cycle. Not going to dive into 506B and 506C investments, but if you know what that is and want more information, you can scan that QR code for a really good resource that I found online. I always like to share with you all different, I didn't talk about accredited investors, but that's kind of part of the 506B and C deals. Really good to know, but I like to include literature and people to follow. These are people I like to follow on Instagram. You can follow on TikTok that are in multifamily. They are in commercial. Invest with Ace does a lot of good underwriting in his short videos. So you can actually experience what underwriting might look like. Heather does more commercial properties. Rod Cleef and Rob Beardsley do basically just multifamily. Same with Grant Cardone, but he doesn't necessarily talk about multifamily on his Instagram. These are some really good books. This is Rod Cleef's 90-day action plan for multifamily. This is an how to underwrite book. I am currently reading it. Here it is. Really good. There are very few books that actually teach underwriting that aren't painfully boring. And then this is a more advanced book. They're both from Rod Beardsley. And they are about structuring deals. Awesome. So those are some good different resources to check out. And here we are. Now we get to move on to our amazing guest speaker, Jennifer. And Jennifer is just awesome. I got to hang out with her at a couple different real estate events, but we got to spend a lot of time in Sarasota at the boardroom. And I know that she does a lot of different real estate investing styles. So she does multifamily, that's her focus now, but also did a lot of rehab projects. And so I am excited for her to be able to share with everyone and compare those two different styles. Since not everyone, I don't have background in anything other than multifamily. So she has 701 units across 5 states as a GP, and is invested in 1,700 doors. So she has a lot of experience, and also super excited to have a female speaker with us. So take it away, Jennifer. Thanks so much for being here.
Well, thank you. And talk about what a wonderful job that you did on a really challenging topic right out of the gate. So I love that you kind of gave everybody a high overview, but actually you went in pretty in depth. So kudos to you for tackling a big topic like this. Most of us hire mentors to help us understand this information, which I believe you have as well, and I did too. So it's just exciting to be here with everybody today. So let me go ahead, if you're okay, I'll share my screen, and hopefully we can see. Okay, it says the host disabled participants sharing.
Um, okay, see if that works.
Let me try again. Yes. Okay.
Perfect.
So I would love to share with you what I've done so that you can see both sides. The one thing I love about real estate is you can pick any lane and you're going to make money in it. And that's the most beautiful piece of real estate. And I love that you've found real estate at such a young age, Caroline. I mean, most people like myself, we didn't, even though so you'll see here, I graduated with a BS degree in business finance, but we never talked about real estate. And I think what a travesty that it was that I didn't get that information out of my college degree and that I had to somehow be invited to an event at 47 years of age that was called this Rich Dad program, which I'd never heard anything about in my entire life. So for those of you in the audience, hopefully you've been exposed to the Rich Dad, Poor Dad book. It is a must read. And when you read it, your eyes are going to be opened and you're going to see the world in a whole new light. And it's just so important that we get the word out about real estate and how important it is because it helps us build generational wealth. And so I've been married for 33 years. I have 4 children. They range from, this slide is now a little dated, 22 to 28 years. And I've been doing real estate since 2015. And people often ask me, do I have a real estate license? And the answer is no, I don't. I believe in abundance. Of course, I didn't learn about abundance mindset until I was exposed to the Rich Dad program. So I was invited with a friend to sit in on a event that her husband couldn't participate in. And so they asked me if I would fill in. And right out of the gates, they started talking about this mailbox money that you could make in real estate. And I thought, mailbox money, what is mailbox money and how do I get some? And the fact that you can buy rentals and start having the checks come to you in the form of rent and pay down the debt on that note, that mortgage, was just mind-boggling. And I thought, this is where I need to be in life. And with 4 kids heading off to college, and with half of our nest egg going away in 2008, I was looking for re-entering into the marketplace and into the job force. And I didn't know what that was going to look like. So I love that real estate gives you that. So as Caroline already mentioned the things that I'm doing in real estate. And after I went through my very first year of buying single family homes, using my IRA to purchase those investment properties, I had completed 11 transactions. So I used my IRA effectively to rehab and sell homes. Plus, I took a home equity line of credit out on our home so that I could afford or pay for the rehab that those homes were going to take. But I reached a point and I thought, how am I going to grow bigger and faster? I'm one person and I have years to make up for, given the loss that we suffered in 2008. So I was really determined that I had to really step up my game very quickly. So I started listening to a lot of podcasts, and Caroline gave you a lot of great resources that will immediately allow you to plug in and get educated. And Caroline did a brilliant job educating you in a very short amount of time. But what I had heard from multifamily is it's the holy grail of real estate. And the reason that is everybody needs a bed to sleep at night. And you can't say that about any other vehicle. Now, the thing with short-term or single-family homes is if somebody loses their job, they can't pay the rent on that particular home, and then you're out and you're responsible for the mortgage. The beautiful thing about a multifamily building, like in the game of Monopoly, you have multiple units in that building. And so if one person loses their job, you still may have 7 other renters in that building that can pay for the mortgage. And hopefully, if you bought it right, you're still going to have cash flow coming back to you at the end of every month. So the reason I love multifamily, you can see on the left here, it's also a great hedge against inflation. When inflation is going up, guess what? I hate to say it, but rents go up with it. And that's just a fact. And unfortunately, we have a 4.3 million unit shortage across the US. And so we have a shortage of beds. And because of that, there's certain markets that are, they're experiencing a huge influx in the rent. And even though we're having a market correction right now, those markets are still trending upward. For example, we're in Jacksonville, Florida. We are still trending upward in that market. And I can't say that about my single family homes. They've kind of leveled out. And now my most important thing is I need to make sure that I have a renter in those homes. Now, thankfully, I paid for them with my IRA. They're completely paid off, but that's not exactly a smart decision either. If I were to go back, I would actually put a mortgage on those homes and partner with my IRA. So then I could leverage my money and take it further and buy more homes. So as you can see here at the very bottom, rents rarely come down on apartments. So typically they'll go up and then they level out. So let's talk a little bit further about multifamily syndication. Caroline alluded to the fact that you could be a limited partner or you can be a general partner. The most beautiful thing is if you have a W-2 job and you love what you do, continue to do what you're doing. Find good people that have been syndicating. We call us sponsors or general partners. Find somebody like myself or like Caroline that have went full cycle on several deals, that understand the market cycles and that can invest your money for you so you can continue doing what you love. And you can be 100% passive with no liability. Now, the general partner, that's me, that's Caroline. We actually source and we find the property. We put the deal together. We find the mortgage lender. We manage the asset. I'm on asset management calls every single week on every single deal that I'm a general partner in, making sure that our property manager is running the property and implementing the business strategy plan that we had determined up front when we bought this asset. And at the end, we only make our money when we paid our investors first, then we get paid as general partners. And I'll tell you, my very favorite deals are the ones I invest in. So if that tells you anything, because I get to give my money to somebody else. And again, I'm also doing like you, I'm scrutinizing the sponsor, making sure they have the same fundamentals that I buy properties with, have the same values as I do. And then I know that I can entrust them with my IRA dollars or other funds that have, been allocated for multifamily or other investment dollars. But those are my favorite investments. So why would you invest in a multifamily passively? Well, you have little to no involvement, like I said, less risk, again, no liability. You get to share in all the upsides. So you get to share in the profit. You have the potential to increase your net worth. So in single family, when we're talking about the pros and cons of each, I look at single family and I think, okay, over here, I get monthly distributions in rent. And again, if I bought right, there will be cash flow left over after I pay the mortgage every single month. Now, over in multifamily, you probably aren't going to see regular distributions on an asset like you will over in single family. The play over in multifamily is you're growing your net worth. And usually when we're buying assets, our goal is to go full cycle on a deal every 3 to 5 years with the hope that we're going to double your investment every single time. That is the goal. It doesn't happen every time, but if we can get 15 to 20% average annualized return on your money every single year, that is way better than what you can do in the stock market. and you have a hard, tangible asset that you get to take taxes on and depreciation on, which helps offset your W-2 income. And one thing I didn't mention over here, and I'm sure you already saw, that you can invest in as little as $50,000. That is a great thing to do. So the fifth bullet point down here is, and you can invest in as little as 50,000. So I recently created this spreadsheet and I said, okay, what if every single year you put $50,000 into 3 different deals? Now, I know that's a lot for a lot of people just getting started, but follow me with the idea and the concept. In 3 to 5 years, all of those are turning over. So every 50,000 is now going to become 100,000. So you just took 150,000 and made it 300,000. And hopefully you can do that in 3 years. I know this last uptake in the market, we certainly saw a lot of people doubling their money. Now, are we going to experience that right now? Probably not, but you should be able to still in 5 to 7 years. Okay. So still better than putting it in the stock market and letting it ride over time. And the beautiful thing is, like I mentioned before, you get tax benefits like accelerated depreciation. So these, again, are strictly how we evaluate multifamily properties. We typically, I mean, while you will do an analysis on your single family homes, this is kind of the standard that you could expect when you invest in a multifamily asset. So the average annualized return, that's the AAR that you see there, is typically between 60 and 20%. And your cash on cash is going to be 7 to 10. Now, that doesn't mean you're going to get 7 to 10% every year. That's actually what we call down here a preferred return. So if we say, hey, we believe we're going to, again, these are assumption, or these are kind of like a pro forma or projections of what we're going to return. And we don't actually know it until we start implementing and we take ownership of the property and start implementing the processes that we've put in place. But again, the goal is to hold this property only 3 to 5 years. In some cases, like Caroline said, you might have a capitalization event because maybe you increase the rent so much that you're able to do a refinancing event and return investors their money. Now, you didn't see a lot of refinancing happening recently, but that's because money was so inexpensive at 3.5%. Now that we're up here, though, you're going to see a lot of refinancing taking place over the next 2 to 5 years. People that are buying assets now up here, they're going to be refinancing and returning a lot of capital to their investors, or they may sell. So it'll be interesting to watch how this compares to the market cycle when we were going up. And again, an equity multiplier, I'd never heard this term before until I got into multifamily, but when you see an equity multiplier of 1.6, this means if I had $100,000 and I gave it to Caroline in, let's say, 4 years, and we're looking at a 20% average annualized return every year. So 24, let's say it's 3 years, you would be looking at getting $160,000 back if we sold in 3 years. Contrastly, if we go a little bit longer, it looks like we could get an equity multiplier of 1.96, which means my 100,000 is now valued at 196,000 when I get all the money back. So this is showing you a $100,000 example with a 7% preferred return. Again, you as a limited partner have nothing that you have to do on this asset except just smile when you get those distributions every quarter. Some general partners actually pay out monthly. So, but you know, and that's becoming more and more common as the software improves. So we've been traditionally using software that pays out quarterly, but now We've found some really great software out there that can calculate for us, and it allows us to pay out monthly. But again, an average annualized return, 60 to 20%. So you'll see here in year one, let's say we project that we're going to pay out a 7% return. So in year one, you get paid out 7%. Year two, $7,000. Year three, $7,000. So in year five, you've accumulated $7,000 times 5 years. That's $35,000. And those are really nice returns over the course of those 5 years. And then you probably would have a sale. And then what would happen is if you were projected to receive $200,000 back, maybe it was a 2 times multiplier, then what they do is say, okay, instead of giving you $200,000 back all at once, you take your $200,000, take off the $35,000 that's already been paid to you, return your $100,000, and that little difference there is what you get in a lump sum. And you will have to pay capital gains on that. So what we try to do is we try to line up another investment that you're going to be able to roll those funds into, so you won't have to experience the hit on those funds. Now, these are just a few assets that we currently own. We've got a 72 unit in Springdale, Arkansas, 130 unit in Greensboro, North Carolina, 80 units in Jackson, Florida, 203 in Atlanta, Georgia, 137 in North Carolina, or excuse me, that one is Greensboro, North Carolina. So there's another property here that it's talking about, North Charleston, South Carolina. So I apologize. We've added another property to our mix here, so you're not seeing all that. But you can see again, our distributions are paid out quarterly. On this one in Jacksonville, we're not paying out until year 2 or 3 because we are completely renovating that on the interiors. There's a lot to do. So before we'll get stabilization, we're not going to be able to hit or pay any of those distributions. So that's something to be aware of. If you're buying a heavy value add product, you probably won't get any distributions, but the syndicator will make up for those distributions at the sale. So keep that in mind. One of the most important pieces when you're investing with somebody is to make sure that they've studied the market and that you have studied the market, and hopefully they'll put together a nice webinar for you and they'll share with you why they love the asset. This is something we all do. I'm sure Caroline does it also, but we talk about the market. What do we like specifically? So when we're buying assets, we want to make sure that the area that we're buying into has a population greater than 85,000, that there's a diversity of employers. It's not a one-horse town. We have a vintage, meaning the age of the asset is greater than 1975. The median income for the area is greater than 50,000. And the reason that's important is, if you recall, you usually only want to designate a third of your income to pay your rent or your mortgage. And so you want to make sure that the median income in the area can support the rent that you're trying to get in that asset. And then we are not big fans on boilers or chillers. And you always want the ability to add value in an asset you're buying, because like Caroline said, you don't buy based on comps. You buy to add value and bump the rent, and then you get paid for the additional value that you've added to the property. And it's all based on a cap rate. And that way, because most assets aren't sitting right next door to each other. So the next best comp to your property may be 5 miles away. So what they do is they use a cap rate for the area. And again, it takes into consideration what's happening in that particular geographical area. Is it a highly desirable area? And if so, that's going to drive the value of that asset up. And again, it goes back to location, location, location. It always is the most important fundamental purchasing strategy. So again, when you're listening to a webinar and somebody is bringing you an asset, you want to make sure you understand the business strategy that they've laid out for this asset. So we are always looking for underperforming assets where the expenses are really high. We're also looking for properties that they have deferred maintenance and they're in a growing, again, highly desirable area. We always involve the local property management team while we're doing our due diligence at the property. And what due diligence means is we're actually going to the property and we're touring every single unit. And we're noting the condition of the hot water tanks, the furnaces, the appliances. We're looking at the lighting, the door handles, faucets. We're looking at everything to see what do we really need to do to get the rent that we want to for this area. And then we will leverage a tax specialist on the onset, as well as we'll find a cost segregation team that will go to the asset and they will itemize everything so that we can accelerate a depreciation schedule on the asset so every single investor can take advantage of that on their income taxes, each and every year. So Caroline didn't really get into this very much, but usually multifamilies will be brought to you in two different ways. You'll either hear about it from a friend or family, or you'll see it being advertised. So if you're learning about it from a friend or a family, this is called a 506B. And, some of this information's a little deep, and I don't know that we need to go into that. Now, a 506C is an offering that you've seen advertised maybe on LinkedIn, or maybe your advisor brings it to you and says, hey, I found out about this investment. Let's take a look at it together and let's decide if it's something that you want to invest in. But real quickly, one of your goals should be, as an investor, is to someday get to that accredited investor status. So there's two different statuses you can hear. Sophisticated means you have a net worth, or excuse me, you make, let me back up. I'm giving you the definition of an accredited. So sophisticated is somebody that has limited experience investing, okay? Accredited investor is somebody that has a net worth greater than $1 million, excluding their personal residence, or they make $200,000 in 2 consecutive calendar years, or again, the third piece of that is you and your spouse make $300,000 in 2 consecutive calendar years. And if you can say that you're one of those, then you're considered an accredited investor. And then you can invest in a 506B or a 506C a 506C for crowdfunding at your discretion. So that's the best place to be.
I'm going to add, there are rules when it comes to syndication put in place by the SEC to ensure that people that are investing their money, usually large amounts of money in these real estate deals, are protected. So that's why they require that only accredited investors invest in certain deals. And you could do a ton of research on that. You can get political on that too. But that's the reasoning as to why it's important to identify as either a sophisticated or an accredited investor, because it determines the types of deals that you're able to actually invest in, and you might be limited.
Exactly. I love that. Thank you. So is now a good time to invest? So back in 2015, when we were starting to come out of the 2008 recession, I started buying single family homes, and I met several investors that said, oh my gosh, I would never be buying right now. We're at the height of the market. And I look back now and I'm so thankful I didn't listen to the negative Nellies that were, tweeting in my ear, because had I listened to them, I would have lost out on some of the greatest opportunities. I still have those single family homes in my portfolio today, and most of them have doubled in value. And I make 15 to 25% year over year, cash on cash. So that's bringing in that income we want every single month, right? And then I'm investing over here in multifamily to grow our net worth and to be able to do so in a very quick manner, because you get the jump in your net worth, because a $25 rent bump for a single family home is not the same as it is over in multifamily. And so I love to share this demonstration. If you're to take $25 and let's say you've got the single family home and you bump it year one, right? Year one, you get a $25 bump. Now let's instead take that on a $100, or excuse me, 100-unit apartment building. Okay, so now we got a $2,500 bump in rent. It sounds like, wow, that's obvious, right? $25 for 100 units, that's 2,500. But the cool thing is when you put it on a cap rate, and let me show you the power of a cap rate. So when I first got into multifamily, cap rates were averaging about 6.5. So let's do this. Let's take 2,500. Let's divide it by a 6.5 cap. So that $2,500 added $38,461 to the bottom line in valuation. Now, let's take that, that was a 6.5 cap. Now we're going to take that same 2,500 and we're going to take it to where we were in the last 2 years, which we were averaging across the US a 4.5 cap. So let's drop it all the way down to 4.5. That is now 55,000. That same 2,500 is now $55,000. That is crazy, right? To think $2,500 adds that much, and that it gets distributed amongst all the limited partners. That's why I love multifamily so much. Again, I like to play in both pools though, to be quite frank. I like my monthly income coming in from my single family homes. And then I also like the big jump that I get every single time I'm investing in a multifamily asset. If I have a choice, I'm always going to choose multifamily though, because it has such a big bump. But if you're somebody that's trying to figure out how can you quit your job, I would tend to probably direct you towards buying single family homes to begin with, because you're going to get that kickback from all of those rents every single month. And over time, you do that enough times, you're going to be financially free. And those rentals are going to give you the luxury to have choices, more choices in life. So again, distributions, I mentioned that they're usually paid out every quarter. And it usually doesn't begin until stabilization occurs at that property. So when we buy an asset, we start to implement our business plan, and we might be not renewing every single tenant in that building because maybe they're not a very good tenant and maybe they pay late all the time. Maybe they don't want the new hike in their rent, and so they're going to choose to move out. So that usually doesn't happen until month 6. So thank you for all that time that you did give me. If you want to book a call with me at any time, or if you want to reach out to me, I'd love to hear from you. I'm Jennifer at lighthouseventures.com. And we'll just kind of get to know one another and see what your investment goals are, and I'll do what I can to help you.
Thanks, Jennifer. You should absolutely take her up on that offer. Jennifer is just one of the best people I've met in real estate so far, and really grateful that you could be here with us. Well, I think Jennifer did a really, really good job of highlighting what it looks like to be an LP, a limited partner, where you can put your money into a deal and invest passively. And I think Jennifer also had a really good point comparing the different investment strategies, which is where I find myself being younger, having started in multifamily. Multifamily is a great way to, I would say, to raise your net worth, but it doesn't necessarily, at least on the GP side, bring in a lot of cash flow. And so now my goal for this year is to find a high cash flowing asset for myself. So I'm looking at single family and I'm looking at short-term rentals since those cash flow pretty well. So that's kind of what this opportunity in this webinar series is for, so that everyone can understand maybe where they are in life, what their investment goals are, understand that there are different strategies, there are different type of assets and asset classes that you can invest in, and determine which one is the best one for you in your place of life and where you are, either financially or the amount of time that you have to give to an asset. Those all can factor in as to which strategy you might employ. So I really loved all of Jennifer's points. I feel like they were very, very good. And I love that you got into some of the math too, as to how you actually get a return on your investment. Feel free to reach out to either of us at any time. Well, thank you, Jennifer, and thank you everyone else. Next week, we have fix and flips, which Jennifer can speak to also. So really looking forward to that next week. Again, if you want to contact me to go ahead and use that QR code. Thank you all so much for attending. And thank you so much, Jennifer. We really appreciate everything that you shared with us.
Well, thank you. And you have a wonderful evening. Look forward to
Thank
connecting
you.
again.
Thanks, everyone. Happy investing.